Vocabulary highlighted in the book, Beginner's Guide to the Stock Market by Kratter Matthew R. 1. I would just urge you to learn how the stock market actually works. 2. The stock market is a complex emergent system. It won't listen to you or to anyone else. 3. You purchased this book because something in the title, cover, or book description resonated with you. 4. A stock is a share of ownership in a company. 5. When I buy 100 shares of McDonald's, I become a partial owner of the company. 6. As I am typing these words, each of these slices is valued by the market at $187.62. 7. Another word for this is market cap or market capitalization. 8. Sometimes the market is temporarily wrong. 9. In 1996, Apple was valued at less than $3 billion. Then the company brought back Steve Jobs, who introduced the iPod and the iPhone. The price of Apple's stock, and hence its market cap, first slowly and then quickly, ramped up as the market began to figure out how successful and profitable these devices would be. 10. That is one thing that makes stocks wiggle around. 11. Then, if a very large investor comes in and starts to dump his stock, the price of the stock will move down. 12. I skate to where the puck is going to be, not to where it has been. The stock market does something similar. 13. That's why we say that the stock market is a forward-looking mechanism or discounting mechanism. Then it really began to rally. 15. The stock is skating to where the company is going to be in a few months. 16. It can take time for new information to get priced into a stock, which means that this stock could continue to move lower for days or even weeks. 17. The next day, the stock gaps up, opens up much higher than where it was trading the previous day. 18. By taking advantage of these slow, lumbering giants. 19. Some people like to buy stocks and hold them for many years. We call them investors. 20. Other people like to buy and sell stocks more quickly, maybe holding them for only an hour, a day, a week, or a month. We call these people traders. 21. I would urge you not to take a side in this debate. 22. Stocks are usually bought and sold on what are called stock exchanges. 23. Stock exchange is a little bit like an eBay for stocks. 24. The most well-known exchanges in the U.S. are the New York Stock Exchange, and the NASDAQ. 25. NYSE stocks are usually identified by a two-letter unique ticker, stock symbol, like KO Coca-Cola or HD Home Depot. 26. As an individual, you cannot trade directly on a stock exchange. 27. A broker is simply a middleman who gives people access to a stock exchange. 28. Robinhood.com is great because they allow you to buy and sell stocks without paying a commission. 29. This is because every stock has a bid price and an offer or ask price. The bid is the price at which someone is willing to buy the stock. The offer is the price at which someone is willing to sell the stock. Memorize this phrase right now. 30. You sell to the bid and you buy from the ask. 31. A liquid stock is defined as a stock where you can buy or sell a lot of shares without moving the stock too much. Liquid stocks in the U.S. usually have a bid-ask spread of just a penny or 2.32. That is why it is usually best to stay away from illiquid stocks. 33. A limit order is the second type of order after a market order. 34. Almost always use limit orders in my trading, even with highly liquid stocks. 35. A day order will only be executed during regular market hours. Today, 36. A GTC, good till canceled, order will be good for today's market hours as well as the following days and weeks. 37. If you're going to trade before the market opens or in the after-hours market, always use a limit order. 38. Volatile means that the stock wiggles around or jumps around a lot. 39. Stocks with lower trading volume will usually be more volatile, with a wide bid-ask spread that also bounces around. 40. Until you become an advanced trader, it is probably best to stick to normal market hours. 41. And please don't ever trade an IPO using market orders. That is the ultimate newbie mistake. More on that in a later chapter. 42. Many investors choose to buy an index rather than a single stock. An index is simply a collection or basket of stocks. 43. Technical note, indices like the S&P 500 are market cap weighted, which means that the companies in them that have larger market caps are given higher weightings and thus have a greater influence on the index. 44. There's the Dow Jones Industrial Average. This is a famous index that goes back to 1896. It always contains only 30 companies. 45. When you hear on the news that the Dow was down 300 points, this is the index that is being referred to. 46. The 30 Dow stocks are usually very large and well-known companies. Sometimes people call them blue chips or blue chip stocks because they are large, mature, profitable, and fairly stable companies. 47. Most NASDAQ 100 companies can be considered blue chip companies as well. 48. Some smart people came up with the idea of the ETF, Exchange Traded Fund. An ETF trades just like a stock. You can buy or sell it all day long in your brokerage account. 49. So the ETF for the S&P 500 trades under the ticker SPY50. If you buy the QQQ and hold it for the long term, you will be able to profit from the long-term growth of the tech industry. 51. Passive investing refers to any strategy that does not involve a lot of thinking. Which stocks should I buy today? Or a lot of buying or selling. 52. When you index, you just buy whatever stocks are in the index. 53. Today, indexing is widely considered the safest and best way for most people to invest in the stock market. 54. In the old days, very few people practiced indexing. That guaranteed that it would provide pretty good returns. These days, anywhere from 50 to 70% of the money in the stock market is tied to indexing. 55. That being said, most people lose money when they try to trade or invest on their own, so they will still be better off pursuing an indexing strategy. 56. That's because active investing strategies, as opposed to passive investing strategies like indexing, are difficult. Most people don't invest in learning the necessary skills to do it well. 57. That is why this practice is called cost averaging. 58. Another way to index is to buy a low-cost mutual fund like the Vanguard 500, which only charges you an expense ratio, annual fee, equal to 0.4% of your investment. 59. Most investors are probably better off starting with the SPY, since you can invest as little as a few $100s. 60. Buying a stock index like the S&P 500 is a great way to get started investing. 61. When you are indexing, it doesn't make any sense to check daily stock or index prices. 62. That being said, a great time to invest in an index like the S&P 500 is during a bear market. 63. A dividend stock will usually make a cash payment into your brokerage account every 3 months. 64. Investing in dividend stocks is one of the best ways to build wealth. 65. It's a good reminder that you don't need to have a high salary to become a millionaire. You just need to spend less than you earn and invest the rest in dividend stocks. 66. The best thing about dividend stocks is that the management and the employees of the company do all of the work, while you get to sit around and collect dividend checks. 67. 3% is what we call the stock's dividend yield. If you put your money in a savings account, you might make 2% every year. That is your savings account's yield. 68. Expressing things in terms of yield allows us to compare different investments. 69. 69. However, when you buy a stock, it can always go down in price and lose you money. That doesn't happen with a savings account. 70. The longer you hold a dividend stock like this, the higher your effective yield becomes. Coke is a special kind of dividend stock. It is a dividend aristocrat, one of an elite group of companies. 72. Other dividend aristocrats include the Colgate, Palmolive Company, Johnson & Johnson, and McDonald's. 73. There's an easy way to own a piece of every dividend aristocrat. Just buy some shares of Noble. 74. In order to pay a dividend, a company needs to be making money itself. Occasionally, a company will borrow money to pay its dividend, but that can never last for very long. 75. Dividends are usually paid out of a company's free cash flow. One of the great things about investing in dividend stocks is that you know that the company is making money. 76. Owning a basket of dividend stocks over a long period of time is one of the best ways to build wealth. 77. Investing like Buffett is hard. You need to pick companies that are going to be around and continuing to do well in 20 years from now. And you must be careful not to overpay for them. 78. That being said, there's a really easy way to pick stocks like Warren Buffett. Just copy him 79. You could also just buy a basket of these stocks that Buffett owns. Buy the basket of stocks and then sell a stock only when you hear that Buffett has exited the position 80. An even easier route might be to just buy some B shares of Berkshire Hathaway, ticker RB. 81. If you study Warren Buffett for many years, as I have, you will begin to notice that his stock picks follow a certain pattern. They are usually strong, well-known brands like Coca-Cola and Apple. He also likes to own financial companies like Bank of America, American Express, and Wells Fargo, probably because these companies are highly leveraged and so make a lot of money during the good times. They also get bailed out by the government during the bad times. 82. You want to own businesses that have good pricing power. This means that they can raise prices without losing customers. 83. When Coke decides to raise its prices by 10 cents per can, you probably don't even notice. But when your local gas station is priced 10 cents above its nearby competition, you will probably go to the competitor instead. 84. It's extremely difficult to get rich owning a price-competitive business. 85. The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. 86. Its most basic level, value investing is about buying something for less than it is worth. 87. PE is a company's price-to-earnings ratio. 88. We can calculate a trailing last 12 months P/E ratio for that stock by simply dividing the stock price, P, by the EPS, E. So 106.50 equals about 1589. Companies that are growing their revenues or earnings quickly, growth stocks, tend to have PEs above 2590. Companies that are in trouble often have P/Es below 1091. Today, people often confuse value investing with buying stocks with low PEs. As we mentioned, that strategy worked well in the past when Warren Buffett was a young man, but it stopped working years ago. 92. Until you become an advanced investor, don't ever buy a stock with a PE of 10 or less. It's just a bad hole to fish in. 93, and probably a few frauds as well. So stay away. 94. Another mistake that new investors make is buying bargain stocks. 95. When the PE of a company hits a 5-year low, many analysts will recommend the stock as a cheap stock. 96. Low PE stocks are almost always pricing in future bad news. 97. Let me give you a good example. In late 2009, you could buy shares of Blockbuster at a PE of 2, or you could buy shares of Netflix at a PE of 26. 98. You must skate to where earnings are going to be, not to where they have been. 99. Paying a cheap price for a stock that is going to zero is never a good deal. We call these situations value traps. They look like good values, but they turn out to be traps at Gumcaps. 100. Yesterday's hot tech company is almost never a good deal when its share price has gone down a lot. Think Yahoo or BlackBerry 101. A low or falling stock price will make it difficult for the company to attract top talent. 102. When you are just getting started, it is probably easier to trade growth stocks and momentum stocks. 103. Hope that after reading this you will never buy a stock just because it is cheap or has a low PE. 104. A growth stock is simply the stock of any company that is expected to rapidly grow its revenues or earnings. 105. Great companies that are rapidly growing will always trade at high PEs. 106. They might even grow their market share for many years before they turn on the profit spigot. 107. That's why we always trade growth stocks with a clear stop loss. 108. If you are Warren Buffett investing in a mature company, the PE does matter. If you are holding a growth stock for a few weeks or even months, nothing could matter less than the PE. 109. I like to buy growth stocks that are hitting new 52-week highs or even all-time new highs. 110. This makes sense simply because any stock that goes up a lot must, almost by definition, spend a lot of time trading at new highs. 111. A new all-time high, everyone who owns the stock has a profit. All of the losers are gone. At new highs, there are only happy traders and investors left. Well, except for one group of traders that no one feels very much sympathy for, the short sellers. 114. A stock that has recently moved up a lot begins to be featured on CNBC and discussed by online commentators. 115. I like to call these rocket stocks. 116. Never buy a growth stock if the stock is trading below its 200-day moving average, or if the 50-day moving average is trading below the 200-day moving average. 117. There is nothing more dangerous than a growth stock in a downtrend. 118. As a small investor, you can ride the wave as larger institutional investors add to their positions over time and thus cause the stock to drift higher. 119. Growth stocks perform much better when the entire stock market is also in an uptrend. 120. Also, I like to look for growth stocks that have a market cap of $5 billion or less. It takes a lot less money to push a $5 billion stock higher than it does a $500 billion market cap stock. 121. Once the stock reaches $5 to $10 billion, there is a whole new set of institutional buyers who will begin to take notice. 122. I also like to look for growth stocks where the float is less than 20% of the total number of shares outstanding. The float is simply the number of shares of a stock that are actually available for trading. 123. Also like to look for growth stocks with a high short interest. Short interest is the quantity of shares that have been sold short by those who believe that the stock will go down. 124. Now, short sellers, traders who are betting that a stock will go down, are usually pretty smart. When a stock keeps hitting new 52-week lows and it has a high short interest, you want to stay away. 125. Here are some of the criteria that I like to use. Take profits when you are so excited and happy about your trade that you are losing sleep. Take profits if a stock moves up 100% in 2 weeks or less. Take profits when you are up 300% from your entry price. Take profits when all of your friends in CNBC 126. Just be sure to never add to a losing position. Pick a stop-loss level when you enter the trade and stick to it. 127. I usually like to risk no more than 1% of my trading account on each stock trade. 128. The key to making a lot of money is not losing a lot of money in the process. 129. When you are first getting started trading, be sure not to dig yourself a hole like this. 130. Keep your losses small and manageable, especially while you are still in the learning phase. 131. If you know what you are doing, IPOs can be a great way to make a lot of money, but if you don't, you will usually be left holding the bag. 132. IPOs allow insiders to cash out while also raising money for a company to use to expand its operations. You will often get a flurry of IPOs at the end of a long bull market, as we saw in 1999-2000, and as we are now seeing in 2019. 134. You are buying from smart insiders who know everything about how the company operates, its strengths and weaknesses, and its future prospects. 135. Short sellers pounced on Lyft. 136. The first way is as a long-term investor. If you bought one share of Coca-Cola for $40 when it IPO'd in 1919 and held on to it, your position would currently be worth more than $15 million, assuming that you used all dividends that the stock paid you to buy more shares. 137. There are just too many IPOs, and many of them are bankrupt just 5 years later. 138. To be a long-term investor in an IPO, you need to know something about the industry and also have a correct view of the company's future prospects. 139. Even Coca-Cola's stock fell 50% in its first 12 months as a public company. 140. There's a further complication. Companies used to go public, IPO, much earlier in their business life cycle. 141. You are probably the dumb money. 42. The second way to approach IPOs is from a trader's perspective. An IPO with a small float has the potential to go up or down a lot, which makes it a great trading vehicle. 143. In my experience, the more hyped an IPO is, the more difficult it will be to profit from it on the long side. 144. If the stock closes below that line, I will immediately exit the trade. It's very important to trade IPOs with a stop loss and strict discipline. 145. Many of those stocks ended up going to zero. 146. If you are trading an IPO, make sure that you are aware of when the lockup expires. 147. Just never sell your stock before you have exited the call position, or you'll risk getting yourself in trouble. 148. By now you've probably realized that this type of trade is called a covered call. 149. Strictly speaking, a day trader will never hold a position overnight. Lots of people try day trading and end up failing. 150. If a fund wants to open a new position in that stock or to add to an existing position, it may take hours, days, or weeks. 151. Once we see their footprints in a stock's price behavior, we can step in front of them and quickly execute our small order. 152. By jumping in front of a large institutional player, 153, exit the stock early if it trades below the lowest price of that first 15 minutes of morning trading. 154. This strategy takes advantage of a stock's tendency to keep moving in the same direction of its morning gap as large institutional players like mutual funds and hedge funds adjust their positions. 155. Don't buy stocks that are hitting 52-week lows. Don't trade penny stocks. Don't short stocks. Don't trade on margin. Don't trade other people's ideas. 156. You are almost always much better off buying a stock that is hitting 52-week highs than one hitting 52-week lows. 157. Remember that there is never just one cockroach. Bad news comes in clusters. 158. Cascade of bad news can often cause a stock to trend down or gap down repeatedly. 159. Again, there is never just one cockroach. 160. Never buy a stock after you have seen the first cockroach. 161. Conversely, when a stock goes up a lot, it can improve the company's fundamentals. 162. You stick to stocks that are trading above their 200-day moving averages or that are hitting 52-week highs, you will do much better than trying to catch falling knives. 163. A penny stock is any stock that trades under $5. Unless you are an advanced trader, you should avoid all penny stocks. I would extend this by encouraging you to also avoid all stocks priced under $10. 164. That is because low-priced stocks are most often associated with lower quality companies. 165. Many of these companies have never made a profit. They may be frauds or shell companies that are designed solely to enrich management and other insiders. In addition, penny stocks are inherently more volatile than higher-priced stocks. 166. Many new traders underestimate the kind of emotional and financial damage that this kind of volatility can cause. 167. To add injury to insult. 168. Stay away from all stocks under $10. 169. Also stay away from trading newsletters that hawk penny stocks. 170. Borrow shares of the stock from your broker. 171. And there was no way out. If you owe your broker money, they can haul you into court and go after your house and savings. 172. Sometimes even the wealthiest investors can be wiped out by shorting a stock. 173. For all of these reasons, shorting stocks is clearly an advanced and risky trading strategy. 174. And never short a penny stock. It's just not worth it. 175. Trading on margin is thus a form of leverage. It amplifies the performance of your portfolio both on the upside and the downside. 176. The first reason never to trade someone else's ideas is that they probably don't know what they are doing. If you get a hot stock tip from your neighbor or at the gym, it's best to ignore it. They probably have no idea what they are talking about. 177. You will also know where your stop loss is, in case the stock goes south. 178. Never buy a stock based on an analyst upgrade, or sell a stock based on an analyst downgrade. 179. I've seen analysts finally downgrade a stock only once it has fallen 50%. Analysts are lagging indicators. 180. The best analysts get hired by hedge funds, and you never hear from them again. The worst analysts stay at the banks or brokerage houses and continue to dispense their mediocre advice. Huge amounts of money have been lost by following their advice. His advice is definitely much better than a hot stock tip from your neighbor. 182. Rather than giving you a fish, I would much rather teach you how to fish for yourself. 183. Reaction to the news is always more important than the news itself. Reaction to an earnings report is always more important than the earnings report itself. 185. If a stock that has had a big run up falls on a good earnings report, it may be a sign that the uptrend is over. 186. The opposite is also true. When a stock still rallies after a bad earnings report, it is a bullish sign. It's also a bullish sign if the stock market rallies after a negative economic report. 187. Many people get stubborn and try to tell the stock market what to do. Smart traders listen to the market instead. 188. You must learn to be content with what the market is currently able to offer you. 189. Don't force a trade. Be patient and wait for the fat pitch. 190. Don't spread yourself too thin by trying to follow too many stocks. 191. Don't average trading losses. Don't throw good money after bad. Never add to a losing position, but feel free to add to a position once it starts to make money. 192. The stock market has a tendency to over-discount identified risks and under-discount unidentified risks. 193. If everyone is talking about something, it's almost always already priced into the market. 194. As we mentioned before, to make money in trading or investing, you need to skate to where the puck is going to be, not to where it has already been. 195. The stock market, as well as individual stocks, will always search out our vulnerabilities and move in such a way as to cause the maximum pain to the maximum number of traders. 196. As long as the market is going up and your stock is going up, don't be in a hurry to take profits. 197. There is a seasonality to the stock market that we should not ignore. 198. September has historically been the weakest month for the stock market. 199. This has led to the famous expression, sell in May and go away. 200. But it does mean that you should be more cautious when trading during the summer months. Many traders and investors are at the beach, so liquidity is lower and volatility is higher. 201. If you are looking for a good long-term investment, buy a company that has the highest sales in its industry. 202. There's no substitute for being number one in your industry. 203. When all of the experts agree, then something different is going to happen in the market. The current conventional wisdom is always already priced into the market. 204. George Soros. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. 205. John Maynard Keynes. Markets can remain irrational longer than you can remain solvent. 206. Dennis Gartman. The markets will return to rationality the moment that you have been rendered insolvent. 207. Bruce Kovner. Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. 218. Don't ever feel that you are very good. The second you do, you are dead. 209. There are old traders and there are bold traders, but there are very few old, bold traders. 210. Buy the strongest stocks that keep moving up. Add to your winners, get rid of your losers, and don't get too greedy. 211. Remember that 75% of new traders quit within the first 3 months. 90% of new traders quit within the first 6 months.